Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Algonquin stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Algonquin is a renewable energy and regulated utility company with assets in the US, Canada, Chile, and Bermuda. It actively invests in hydroelectric, wind, and solar power facilities, as well as utility businesses. The company operates in the regulated and unregulated utility sector. Regulated utilities own and operate all electricity. That means the utility company owns the infrastructure and transmission lines, then sells it directly to the customers. Also, regulated utilities must charge rates set by the state. Unregulated markets are when non-utility entities own power plants and transmission lines and sell electricity into a wholesale market. Retail suppliers purchase this electricity and sell it to end users. Another way to describe it is in a regulated market, a company operates a vertically integrated monopoly that covers the entire value chain with oversight from a public regulator. In a deregulated electricity market, market participants other than the utility companies own power plants and transmission lines. Utilities are regulated monopolies, meaning they're the only companies legally allowed to deliver electricity or gas to people within a certain geographic area. The company is headquartered in Oakville, Ontario, Canada, and was founded in 1988. It can be found on the New York Stock Exchange, TSX, and Deutsche Börse. Let's get started with the model. This is a mid-cap company, 9.1 billion market cap. They're trading at $14 a share, and they have 672 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they did have a small positive in 2018 and 19, a big negative in 2020 and the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's positive every year, peaking in 2020. Revenue is the sales for the company, and that was pretty steady in 18, 19, and 20. It did grow a lot in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that peaked in the trailing 12 months at 1.5 billion. Then below that is their operating expenses, and then their operating income, which is pretty steady each year, around $380 million. They have about $7 billion of debt on their balance sheet, so they paid a little over $200 million of interest on that debt. That's the most they paid in the past few years. And the bottom line of the income statement is their net income, which is positive every year. So their income statement looks pretty good. Here's their most recent income statement from their third quarter report. This is the third quarter of 2021 versus the third quarter of 2020. And this gives us a little more detail than Yahoo Finance. They had $529 million of revenue. Most of their revenue comes from the regulated market. In electricity, it was $308 million. Gas was $63 million, and water was $64 million. Water reclamation is the process of treating wastewater into reusable water, and it must be in accordance with water quality standards. Every year, 3.6 million people die from contaminated water. So that's why states and governments really rely on companies like Algonquin to help them treat the water, because the governments just don't have the money to do all that work. Being a regulated utility is like guaranteed income, and you don't have to worry about marketing to people because people need electricity, gas, water, and the rates are set. There's no negotiation, and they can't go anywhere else, unless of course they want to pay a premium for another service. So below revenue is a breakdown of their expenses. Operating expenses of $177 million. These are the costs to operate the facilities, also payroll costs, rent, things like that. So you can see these are great margins. It cost them $94 million to purchase regulated electricity, and they charged $308 million. They paid $14.5 million for gas, and they charged $63 million. Their best margins are regulated water. It cost them only $4 million, and they charged $64 million. Non-regulated energy cost them $12 million, they charged $74 million. Then you have admin expenses. Payroll is a big admin expense. Depreciation and amortization, because they have lots of fixed assets, so they're always passing through depreciation each year. So their operating income improved from $95 million to $114 million. They paid $52 million of interest on their debt, and the reason they have negative net income in the third quarter is this large loss they passed through. It's a long-term investment loss. So when you look at the income statement, it looks like they did a lot better in the third quarter of 2020 versus the third quarter of 2021. When we look at the statement of cash flows later, you'll see the opposite is true. They did a lot better in the third quarter of 2021 versus the third quarter of 2020. This chart breaks out the $114 million loss, and it's mainly from Atlantica. They invested in this company, Atlantica, and they have to mark to market their investments, which means they have to report whether those investments have gone up or down. Their investment went down $139 million in Atlantica in the third quarter. If you bought $100,000 of Apple, and let's say next month the value of your Apple stock is $90,000, you have a mark-to-market loss of $10,000 or an unrealized loss of $10,000. You didn't lose anything until you sell your stock. Same thing with this company. There's no cash loss. It's an unrealized loss. If they sell their stake in Atlantica, then they'll have to pass through a $139 million cash loss. But right now, it doesn't affect cash. It's just an accounting loss. You'll see in a statement of cash flows in a little bit that we add back this $139 million. This $23.5 million, this is the dividends this company received and the interest income they received. So this will be a cash item, so we don't have to reverse this out on the statement of cash flows. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you can see they do generate a good amount of operating cash flow each year. It was low in the trailing 12 months, but that could be due to changes in working capital, which is more of a timing thing. And they spend a lot of money in CapEx, particularly in their renewable energy division. They're spending a lot to grow that part of the business. So they do have negative free cash flow, a big negative in 2020 and the trailing 12 months. But the idea is when you spend in CapEx, it will lead to more free cash flow in the future. So sometimes companies sacrifice profits or cash flow in the early years for greater growth in the future. And they're issuing a little more debt each year than they're paying down. And they seem to add stock each year, a few $100 million a year. So when a company adds common stock, it dilutes the current shareholders and makes your shares less valuable. But they did have negative $280 million of free cash flow, so they needed money from somewhere to fund their growth. That's why they added so much stock and also a little bit of debt. They added about $1 billion of debt, which makes sense because they had negative $1.1 billion of free cash flow. So since they added $1 billion of debt and about $400 million of stock, that's $1.4 billion. But in their financing section, they had a cash inflow of $2 billion. So they must have added $600 million and something else. This is their cash flow from operations in the third quarter of 2021 versus the third quarter of 2020. And the way you calculate CFO, you start with net income or net loss, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. We have to add back the $97 million of depreciation since that's a non-cash item. And you see we're adding back $139 million because this $139 million brought down our net income, but we add it back here because we have to convert net income into cash. Even though they reported a loss of $39 million, they actually generated $174 million of cash flow, which is $50 million more cash than the same period last year. So even though their net income looks so much better in the third quarter of 2020, they actually generated $50 million less of cash. That's why I like to follow the cash. That's a much better indicator of how the company's doing financially. This is the company's investing section from their statement of cash flows, and it starts with CapEx, investments in property, plant, and equipment. That was $348 million. So they're still investing a lot in the CapEx. They spent $119 million in long-term investments. This is investments into other companies. If it was a short-term investment, like they bought treasury bonds so they don't have to sit on cash, then that would appear in the cash flow from operations section. but since it's a long-term investment, it appears in the cash flow from investing section. They had a cash outflow of $474 million in the third quarter of 2021. This is their cash flow from financing section. In this section, you'll see changes to long-term liabilities, also changes to short-term notes payable, and all the changes in your equity accounts like common stock, paid-in capital, and treasury stock. So they added $1.8 billion of debt. They paid down $1.5 billion of debt. They issued $105 million of stock. They paid $82 million of dividends to their common stockholders. They paid $2 million in dividends to their preferred shareholders. They had a cash outflow of $5 million and $3.4 million to non-controlling interests. When you see distributions to non-controlling interest, that means Company X owns less than 50% of a subsidiary of Algonquin. I'm going to call the subsidiary Company S. There may be distributions to Company X when Company X sells its equity in Company S back to Algonquin. Also, there may be cash inflows when Company X buys more equity of Company S. And distributions to non-controlling interest doesn't include dividends. That's the really simple way to explain it. In Algonquin's situation, Aegis was an investee in AY Holdings. AY Holdings is Atlantica. Atlantica is a subsidiary of Algonquin. I pulled this blurb from Atlantica's annual report. Algonquin is our largest shareholder and exercises substantial influence over us. So pretty much anything that happens to Atlantica affects Algonquin. If Atlantica is really profitable, Algonquin benefits. If Atlantica loses a lot of money, Algonquin suffers. So in the third quarter of 2021, the company had a cash inflow of $284 million. This is the equity section of the company's balance sheet. They have $5 billion of equity. They raised $5.4 billion from selling common stock. They raised $184 million from selling preferred stock. And they have negative retained earnings. Retained earnings is a sum of all your prior net incomes minus the sum of the dividends you paid out. So sometimes companies have negative retained earnings if they pay a lot out in dividends, and also if they have a lot of fixed assets because they're passing through lots of depreciation expenses. So they're probably cash flow positive, but historically on the income statement, they have a net loss. Let's look at the capital structure. They have $5.1 billion of equity, $6.9 billion of debt. So they're 43% equity, 57% debt. And I gave them the lowest WACC on Finbox, 6.5%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $18 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $14 billion. We divide that by 672 million shares. And we get a calculated stock price of $21. They're trading at $14, so they're trading at a 35% discount. It's a buy according to the model. The average analyst projects their revenue to grow 13.1%. So to calculate their future revenue estimates, I just grew at 13.1% for the next 4 years. And I figured they'd have negative free cash flow until the end of 2022. The way I figured out their 2023 and 24 free cash flows, I looked at all the other companies in this industry that I did a video on, and the average of those companies converts 19.5% of their revenue to free cash flow. So I multiplied their 2023 and 2024 revenue by 19.5%. That's how I got their future free cash flows. Because right now they're investing so much back into their business, they either have negative free cash flow or hardly any. So it wouldn't make sense to see what percent of their revenue they convert to free cash flow, because right now it's going to be really low, that percentage. It's actually going to be negative. But in the future, it should be a lot stronger, especially once they stop investing so much back into their business. Simply Wall Street values the company at $33 a share. They're saying it's 59% undervalued. 5 analysts priced this stock and the average price target was $15. This is where the stock has been trading the last 5 years. So in the beginning of 2021, it reached its peak about $18 a share. This big drop right here is the crash last March. And there was a ton of selling activity at this point. That was right before they paid their dividend. But they didn't cut their dividend, they actually increased it 1 penny, so it must have been something else. They raised their dividend each year. It was 11 cents in 2016 up to 17 cents. They pay a 5% dividend yield, which is 87% of their net income. They do pay a generous dividend. The industry average is 3.4%, so they're a lot higher than their industry. They have a really low beta, 0.17. The stock has gone down 16% in the past 52 weeks, while the S&P is up 24%. The 52-week low was 13, the high was 18. And the stock is on a decline, trading below its 50-day and 200-day moving average. About 2.5 million shares are traded on this stock each day. Pretty much all the shares outstanding are on float. 46% are held by institutions, and about 2.5% of the shares are shorted. They seem to be aggressively growing their business, acquiring companies, and also growing organically. Their employee count quadrupled from about 1,000 to 4,000. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd be really happy at $32,000 today. That's a 12% annual return. Most high dividend paying stocks don't have such a great return on investment, but this is much better than average. The only insider activity was a sell back in May for 22,000 shares. The biggest shareholders BMO, then RBC, Vanguard, TD Asset, and Canadian Imperial Bank. Let's look at their financial ratios. They have a pretty good PE at 17.2, so investors are paying $17 for $1 of earnings. And they seem to be in growth mode, so that is a pretty impressive PE. A good price to sales of 4.2, that's between the market median and average, and their price to book is 1.8, which is pretty good. They have $1.3 billion of intangible assets on their balance sheet. Their return on invested capital is kind of low at 2.6%. They can cover their interest payments almost 2 times with their operating income. They do have a high ROE at 10%. They have a low current ratio and quick ratio, but that's not bad because they do have a lot of cash flow coming in. They have $190 million of cash on their balance sheet, $325 million of receivables. They also have $68 million worth of fuel and natural gas and storage, $100 million of inventory. So they do seem to be really undercapitalized. They had negative $1.1 billion of free cash flow in the trailing 12 months, negative $565 million of working capital, and they pay out $460 million in dividend payments. So they're short $2 billion. So they're probably going to need to add more debt or equity over the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 4 other companies in the same industry as Algonquin. And Algonquin is better than average in every category except current ratio. Most companies in this industry have a current ratio below 1. Only one company is above 1. A little better than average in price of sales, the best price to book. They're better than average in current ratio, a little less debt than the average company. And they're the second biggest company on this list, and they pay the second highest dividend. To summarize, I have them trading at a 35% discount. This is a pretty safe dividend because most of their revenue is in a regulated market. So there's not much risk of them losing that revenue. And they operate in a business that's highly needed by pretty much everybody. And they're part of a controlled monopoly, so it's a win-win. I rank their free cash flow as 1 out of 10, their revenue 8 out of 10, and their ratio is 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.